Elise and Alan, good afternoon. Thank you very much for stopping by today in short notice. As you know, we've been talking over the past few months about your financial position, your cash flow, where you want to go, and your financial goal. So I finalized my report, and I understand from the conversation we had on the phone that you only have 15 minutes today, 10-15 minutes. So I think it'd be best to reschedule another meeting at some point and discuss all the recommendations that I have and cover all your goals. But today I wanted to specifically touch on your retirement, as I know that was your main objective. So before I dive into the material, I just wanted to brush off on the assumption that we use, just to make sure that we stay on the same page on those assumptions. So we use a 80% pre-retirement income level for a period of 30 years, and we use a time horizon of 15 years. And we also use an inflation rate of 3.5% and a rate of return of approximately 10%. So before I dive into, you have to understand that those assumptions my calculation were based on those assumptions, and so my recommendations are based on those assumptions. So a slight change of those assumptions could have a material impact in the calculation and could change my recommendation. So that's very important that you guys keep this in mind. So now that's being said, I'll dive into the details of my recommendation. So not going into the calculation detail, this is in my plan report that we could cover at some point in the future. But just to give you a quick rundown on key amounts. So using those assumptions and using two different approaches as you wanted. One being the capital utilization, which is using the principal and the interest, and the other method approach being the capital preservation, being just using the interest and not tapping into your principal. So using the capital utilization approach, that gives me a total required retirement fund that I need to accumulate at retirement time of 2.2 million. So in 15 years, you would have to have $2.2 million to satisfy your retirement goal. That's using the capital utilization. If you use the capital preservation, sorry, that amount grows to 2.6. So there's a 0.4 million increase. So that will make the objective even more hard to achieve. So I'll stick with the utilization approach, and I'll explain to you a little bit later. So that 2.2 million is what you need to build in 15 years. So in today's present value in today's dollars is approximately $531,000. So it's either you have a lump sum to fund this amount in today's dollars, or you can save each year for 15 years at 10% to which is approximately $70,000, which you don't have given the current status of your cash flow. So you mentioned that you have assigned assets with a market value of $200,000, and those assets include your IRA, your brokerage account, and your profit sharing balance with your company. So if you back that out from that $530,000 required amount, that's still a shortage of roughly $330,000. Which is the equivalent of $43,000 per year for 15 years at 10%. So if you look at me and you can see that it's a very aggressive objective. So what I've done, and it's in the report, and we could cover that at some point in the future, I came up with different options. The option that I came up with was reducing the retirement period from 30 to 20 years. And reducing the pre-retirement income from 80 to 70%. And even with changing those assumptions, the annual required savings are pretty high and pretty aggressive to achieve, again, in light of your current situation. So I think, and this is what I recommended, the best approach that I recommend is to is to factor in your Social Security benefits. This is money that you'll get at retirement. You won't get 100% of the retirement benefits because you'll be retiring at 65 at least, and you'll be 62. So looking in the Social Security website, you'll be entitled respectively 80% at least and 70% for you. And so when you factor this in your calculation, you still the annual required payment is now $25,000. So that's a different number you're looking at here compared to the 43 that I mentioned earlier. So, and again, at least I can see you looking at me and say it doesn't add up because you have 10,000 approximately of excess cash flow and the requirement is 25. So the report also mentioned ways to get there. One of the ways was to reduce your consumer debt because they're pretty high. We have a standard ratio of best practice of 20%. That's the maximum that is recommended best practice. And you currently sits at 29.5. So you carry significant debts. And the reason I'm recommending retiring them is because they carry interest rates which are not deductible, and I'd rather have additional cash flow to use towards your retirement objective and be assigned to your retirement accounts which have instant tax advantages. So by retiring, again, not going into too much detail, but by retiring your credit card loan, at least your car loan, and the margin loan that you have with your current liquid assets and the money market account in your brokerage, and you'll be able to save and generate additional cash flow of $10,000. So adding this $10,000 to your current $11,000 annual cash flow, you come close to that 25, and you'll break that bridge by simply investing in your 401k that you have with your employer. You currently have not funded your 401ks, and one major advantage of a 401k is the contribution of tax deductible. So you'll be able to reduce your tax liability. Your earnings grow tax deferred until you retire, where I'll be taxed at your ordinary income. But the other advantage of it is the employer is doing a matching, so it's matching 50 cents on the dollar up to 3% of your compensation. So my recommendation was to maximizing on those 401k in order to be able to collect 100% of the matching. So that will be able to get you'll get those tax advantages and $3 from your employer. You also have a traditional IRA, and I recommend in moving this money from a traditional, rolling it over to a Roth IRA. And the reason being is simple. It's because with the Roth IRA, you contribute with after-tax dollars, so the contribution already taxed. It grows tax deferred, but when you withdraw after 59.5 years old and after leaving it open for 5 years, everything is tax-free. So you'll get dollar per dollar, so there won't be tax down the road. So you'll diversify your income stream for your revenue. So that was my recommendation. The other advantage that you have with a Roth IRA is you don't have the requirement minimum distribution that you have to make in a traditional IRA after 70.5 years old, and you don't have that with a Roth IRA. So I think those are the recommendations that I have. Retiring some of the consumer debt to generate additional cash flow to use and fund your 401k and Roth IRA. And the other way of raising your cash flow is simply, and you expressed you expressed an interest in me like digging into this a bit further. It's just on your 1040. You know, you use a standard deduction, and know that you have a house loan, a mortgage. At the early age, most of your mortgage payments are made up of interest, and those you can itemize them, as well as your property taxes and your church contribution. So I run down the numbers, and you probably end up saving $3,000 by just using Schedule A of your Form 1040. So Just to summarize, your retirement goal would be able to be achieved by just factoring your social security, and retiring your consumer debt, and using a Roth IRA. So that would be able those together will help you achieve that goal. I think this is it for today. I know I only had 10 to 15 minutes, so I brushed it off pretty fast. But if you have any question, just let me know. You can still give me a call anytime. You have my phone number. And we still need to get in touch to make sure we book an appointment just to go over the financial plan and all the recommendations. So thank you again for coming today, and I hope to see you soon. Thank you. Bye.